Assalamu alaikum friends, welcome to SBR revision series of September 2021, and today we are going to cover IAS 8 accounting policies, changes in accounting estimates and error. These are the three areas, and the accounting adjustments for policies, estimates and error is different. Okay, and this is a very short standard. So we are going to cover how do you select accounting policies, what is the impact of selecting an accounting policy, changing accounting policies and error, how do you account for this. Okay, so for this I have created a table. Okay, everything in this table only you need to remember for the standard, that's it. Let's start with selecting accounting policies. So when you select accounting policies, okay, accounting policies must be determined by applying the relevant IFRS standard. Okay, you have to apply the IFRS standard. If there is no standard, then management should choose an accounting policy that results in relevant and reliable financial information. You understanding? If there is an appropriate standard for it, you have to use that standards policy. Wherever you have to select an accounting policies, you have to first go and see what the standard says on it. If there is no specific standard, then you have to see that whatever the accounting policies you are adopting, okay, it should result in reliable and relevant financial information. Both these fundamental characteristics of useful information should be there, relevant and reliable. So when you change the accounting policy, this is for selecting accounting policy. We select based on the specific standard. Specific standard is not there, based on relevant and reliability. When you have to change the accounting policies, there are situations that comes in an entity that you have to change accounting policies sometimes. Okay, but accounting policies can only change if two conditions are there. Only under these two conditions you can change. Other than this, you cannot change accounting policy. Number one, the change is required by the standard or interpretation. Right? Very recently, if you see your current issue, you will understand this better. Because in the current issues, normally they are changing the standard, the policies. Why? They are updating themselves. No, every standard needs to be updated. One example is IAS 19. IAS 19 they've updated, so there was some change in accounting policies now under IAS 19. Definitely when we go through IAS 19 and current issues, we'll cover that change in depth, but for now it was just an example I've used. Because it was required by that IAS 19, it was required by that standard, so they changed the accounting policy. Number two, the change is needed because the change means more reliable and relevant information will be presented. Because you feel that according to that old accounting policy that you have been using out, the information that you're presenting is not relevant for that situation and not reliable also. In that condition, you can change the accounting policy. So two conditions: required by the standard or results in more relevant and reliable information. Then you can change accounting policy. Changes in accounting policy, how do you account for it? Changes in accounting policies are accounted for retrospectively as if new policy had always been applied. Retrospectively means you go back and change the figure. You go in the past and change the figure. From the day you have been applying that old accounting policies, you have to now change it and adapt it as if you are applying the new standard from day one before this changes happened. So you have to account for retrospectively. The word is retrospectively. Now, don't get confused with estimate. Changes in accounting estimate and changes in accounting policies are two different things. One example is depreciation. Depreciation is change in estimate. It is not a change in accounting policy. See, estimate means what? Wherever you have, you cannot verify it objectively. You are estimating, you are just guessing out. It is subjective in nature. One example is depreciation. For example, the useful life of the depreciation. The percentages that you apply to the depreciation, 30%, 20% if it's on a straight line basis. The method that you have to use. So if you change the rate, depreciation rate or the useful life of the depreciation, it is, you're changing the estimate because you're estimating it. Okay, if anything where you are not estimating, it comes under accounting policy. So this is the easiest way for you to remember whether it is estimate or it falls under policy. Because if it's estimate, it is accounted differently. If it is accounting policy, it is dealt differently. If it is accounting policy, retrospectively. But if it is accounting estimate, then prospectively, not retrospectively. If it is a change in depreciation, you don't go back and change in the past. What happens? You keep the depreciation rate as it is, useful life as it is. Now, from that day when you have changing it, from that day onwards in the future, you'll be changing it. You'll be using the new figure. Understood? Third one is error. So we are finished with policy, we are finished with estimate, and third one is error. Okay? Prior period errors. That means this error you have done before. Now you have to correct this error. Okay? It could be for two things. Either you are making an error, or it could be a fraud. Unintentional error, or it could be a fraud. Whatever it is, because of this error, there are misstatements now. Okay? You need to correct this error. Go back and change it retrospectively. So this also retrospectively you have to change. Correct the error. Okay? So accounting policies and accounting error. These two things are retrospectively you have to change. Accounting estimate only you have to change prospectively in the future. You don't have to go back and change. So that's it. For IAS 8 you have to remember. So next we are going to cover IAS 10, events after the reporting date. So thank you for watching and see you in the next video.